It does take us to our talk of the tape. After such a strong rebound, is there enough left in the tank to take stocks much higher? Let's ask the Wharton School professor of finance, Jeremy Siegel. He is also Wisdom Tree's chief economist. It's always good to see you on what's become a Friday tradition. Hope you're well.
I'm well, Scott. Thank you.
So it's been an incredible comeback. Does it have more steam?
Yeah, I think so. I'm becoming more bullish. I call it the Trump pivot. Remember 6 months ago we were talking about the Powell pivot? I think the Trump pivot, the day that we saw those tariffs go, from 145 to 30, I think right now it's coming into focus. It's going to be a 10 and 30. 10 basically for the rest of the world, 30 for China, and of course, aluminum, steel, a couple more on there. But it's coming into focus. It's not a good thing. It isn't positive. Listen, I think without the tariffs, the stock market would be 10% higher. But it has the market has a lot of positive things, I think, going for it. I like the low prints I see on inflation. Yes, I do know that the tariffs are going to be coming up, but I think that is definitely positive. I like what Trump is doing in the Mideast and Saudi and Qatar, and that's a huge area, a positive area there. And I just like the way that the market is reacting to potentially negative news. I mean, how it brushed off, as you mentioned at the top of the show, the budget committee turning down the tax proposal, a brief dip, but then a rise. By the way, that's going to get done. I've seen this many times before. You've seen it many times before. We will get a tax deal coming up. So I think this market could surprise everyone by hitting new highs.
Wow, an incredible change of tone. And many do believe that the tone and tenor of this market, Professor, has in fact changed since last week. It's evidenced by what you see in the markets here. And you mentioned some of the data, the real data. The debate now is whether the soft data is going to bleed into and become real data. Consumer confidence, Rick Santelli was just talking about it, the second worst read ever of all time. And at the same time, inflation expectations are really ratcheted up. That's not a problem, either of those metrics?
Well, let me talk about that second metric. 7.4% for 1 year is no econometric model, even the most pessimistic, has anything like that as the inflation rate over the next 12 months. I think, whatever scare is being put into people, oh my God, they keep on ramping up and they're hearing 20%, 30%. No, I mean, the best estimates I'm getting is that the tariffs will probably bump up the CPI by 1.5 percentage points, maybe 2 over the next 12 to 18 months. It will slow growth. Looks like GDP this year is going to be 1% rather than 2%, which we saw in December, but nothing like the data that, we're seeing on that University of Michigan sentiment. So I think people might be saying, hey, you know what? This isn't as bad as I had thought. Another positive feature, the dollar is 10% lower, and there's two positives about that. First of all, that helps the multinationals' earnings, certainly translated from euros and other currencies into the dollar. That's a tailwind there. But even though the S&P and AI is maybe 5 to 10% off its highs in the U.S., it's 15 to 20% off for Europeans and non-U.S. investors because the dollar has dropped. So they're actually picking up some of the best companies in the world everywhere at a price considerably cheaper than what they saw just 6 months ago.